Okay, the next section in this chapter is to compute the amount of life insurance an individual should own. And basically there are two main methods. The first one is called the human life value method, which is a simple method to quantify the amount of insurance needed on a person's life. So there are three steps to use this human life value method. The first one is to estimate the breadwinner's average annual income until he or she retires. The second step would be to determine the remaining number of years till retirement, and the third one is to assume a reasonable discount rate. And for this purpose, we will use a fixed deposit rate. So this is a very simple example. Here we assume that Aisha, age 35, takes home a salary of 60,000 per annum, after deducting EPF and income tax. She plans to retire at age 60, and assuming a discount rate of 4% per annum, and that the income is received at the end of the period, compute Aisha's human life value today. So what's happening here is that we will assume that her take-home salary will be constant from now, which is age 35, up to retirement, which is 25 years, 60 years minus 35 is 25 years. And basically what we are doing is we are computing the present value of an annuity. Okay, so we want to find out how much insurance Aisha needs today. Okay, so it's present value of an annuity. So assuming that Aisha were to take up a policy, we have to assume that death might occur tomorrow. Okay, so that's why we are bringing or computing the present value of this annuity, so that the beneficiaries will receive the 60,000 per annum annually. So what we do is we can use a financial calculator, and the mode is N mode. PMT, or the annuities, is 60,000, N is 25, I is 4%. So we compute the present value. So if we use the financial calculator, we would get PV equals to 937,325. So we can also use a present value of annuities table, and you can compute or use the factor given in the table, and you would get the same value. So it is we can summarize that Aisha's human life value today is 937,325 ringgit, and she should be protected by insurance of this amount. So that is a very simple way to compute a person's human life value based on the earnings per annum. There are several disadvantages of using the human life value method. The first disadvantage or limitation is that it assumes the breadwinner's earnings are constant throughout his or her career. So we assume that the earnings do not increase. Secondly is that it doesn't provide for variations in income or expenses throughout life, or consider for life major events. For example, the insured might have a child, or they might need extra expenses to upgrade the home, or should there be life-changing events such as a divorce. So it doesn't provide for variations that would happen in the future. Also, the variations in the assumed discount rate will lead to different results. So here in this example, we use 4% as a discount rate. So that is only an assumption. So if we use different discount rates, it will lead to different results. So we must use a reasonable discount rate. So lastly, inflation on future earnings and expenses are not taken into account. Okay, so basically we assume that there's no inflation and there are no expenses. The next method to compute the amount of life insurance to own is the needs-based approach. This approach allows for a more comprehensive method of determining an individual's life insurance needs based on his or her unique needs and priorities. Important family needs could be regular income needs as well as lump sum capital needs. Yeah, so a person's needs or expenses that they require in life differ from one person to another. Yeah, because each person would have their unique circumstances. So under the needs-based approach, there are two specific methods. One is a capital liquidation method and a capital preservation method. So there's a very slight difference between the two. Basically, the first method, the capital liquidation method, is that we are still trying to compute the present value of what would be required by the beneficiaries in the future. So we are still taking into consideration the annuities that we want the beneficiaries to receive in the future, but at the same time we are also taking into consideration other needs, like whether this person has a housing loan or a car loan, yeah, which needs to be paid up as well. So under the capital liquidation method, we assume that the lump sum or the life insurance amount that is to be owned will be paid out until the funds are exhausted, yeah, at a certain period of time. Whereas the capital preservation method, we are assuming that these life insurance funds will continue perpetually, okay, whereby the annuities will be perpetual and there's no time frame whereby the capital will be exhausted. Yeah, so capital liquidation method, we assume that this capital sum of money, yeah, or the insurance sum assured will be exhausted by certain number of years, whereas the preservation method, we are assuming that the funds remain, yeah, and it is perpetual, the annuities are perpetual. The next method, yeah, is the capital liquidation method. Here we will just basically go through this method. Firstly, what we'll do is to undertake these 5 steps. The first one is to compute the net worth of the insured, which is the total assets minus total liabilities, and then we would compute the capital, yeah, needed to generate regular income needs. So this is something like what we did under the human life value method, whereby we will take the present value of regular income required, or the PMT, the annuities, at a specific interest rate I for a specific number of years end. And then we would compute the lump sum capital needs. So for example, maybe this the insured has some liabilities like housing loan or car loan and other needs to be settled upon the breadwinner's death. So we need to take into consideration all those liabilities. Next, we will also need to consider any other assets that the insured might have. For example, we would need to compute the sum of liquid assets which can be invested to produce an income. So if if the insured already has a lot of assets, so there may not be a need to take up so much of insurance. Yeah, so basically, how do we compute the shortfall required, or the sum insured that is required? Yeah, so basically we would take the total capital needed from item number 2, we would add up with the total liabilities, all his loans that need to be settled, yeah, upon death. And number 3, we would need to minus out the available income from net income producing assets. Yeah, so whatever assets that this person has, we need to minus out. In your textbook, okay, there is a very specific example is very long, so I think it's not feasible for us to use e-learning. So I hope that you will be able to go through the example yourself. Okay, it's quite long because it would, give a lot of example as like a case study of a person of certain income and situation, basically things that you already cover if you had taken applied financial planning. Okay, so is almost exactly the same, yeah, as what you learn in applied financial planning. So I think for this for our learning for this chapter, I will just breeze through. Yeah, we don't have to go through in detail. I hope that you can revise, yeah, from your textbook. Another type of needs-based approach is the capital preservation method. So the only difference compared to the capital liquidation method is item number 2, whereby we will assume that the capital is required for an indefinite time period. Yeah, so in the capital liquidation method, we assume that there is an end. Okay, how many years we want the annuities to go on. But for this example, we will just take the total income requirement or the annuity divided by a certain interest rate, yeah, that we shall assume. And then the rest are the same, yeah, the rest of the methods are the same. If compared to the capital liquidation method, obviously the capital preservation method is you will get a very much higher sum assured, because basically the capital needed to cater for the regular income needs is perpetual. Yeah, it's a perpetuity. Okay, there is no specific time frame. Okay, so in your textbook, you should go through the example by yourself, yeah, and to try to compute what is the capital shortfall or the additional insurance that is required.